Hi, my name is David Penn, and along with my partner Colin Cook, we'll be showing you the history of the various filing statuses of the Internal Revenue Code, along with how to apply them in their current state. Now, going through the history, we'll talk about how it started, and how filing statuses developed, and what they are now. And then the application, Colin will take that and work through all of the different statuses and how they can be applied to find the most preferential tax treatment for your income. Now, in the original 1913 Revenue Code, the Revenue Code only provided for the filing of single tax returns and no other statuses existed, and that's because the focus was on the income of the individual. However, after multiple complaints from many states, because different couples in different states were being treated differently as a result of whether or not the state was a community property state, Congress decided in the 1948 Revenue Act to add the married filing jointly elective status. And this was in response to the community property state issues, as well as some tax cases such as Lucas v. Earl, in which an attorney and his wife signed a contract so as to make the earnings from his cases joint between the two. 52 was the next development to the tax code's filing statuses. That was when the head of household status was created. This status gave preferential treatment to those with a qualifying child or dependent but no spouse, allowing them to have the benefits of a lower tax bracket without having to be giving those filing as head of household a more advantageous tax status than those filing otherwise single. Next, in 1954, Congress added the status of surviving spouse, which allows for a living spouse of the recently deceased to enjoy married filing jointly status rates without actually being married. If they qualify as a qualifying widow, then they can enjoy the married filing jointly benefits. Today, the filing statuses remain unchanged. Those statuses are single, married filing jointly, married filing separately, surviving spouse, which can qualify for a qualifying widow or widower, and head of household. Next, my partner Colin will get into each of these statuses, the restrictions, the qualifications, and how to apply them so as to find the most beneficial tax treatment for you or your client. Thank you.
A taxpayer may be able to claim more than one filing status. However, the prudent taxpayer will choose the filing status that results in the lowest tax liability. The head of household filing status is commonly misconceived as simply being the person who wears the pants in the family. However, this status is for unmarried people or people considered unmarried on the last day of the taxable year that have paid more than one half of the cost for the home upkeep and support a qualifying person who has lived in the home for more than half the year. This qualifying person can be a child under 19, or if the child is a student, under 24. The qualifying person can also be the taxpayer's parents and sometimes even siblings and in-laws. You just have to prove that you provide at least half their support. Bigger deductions and exemptions than a single filer are available under the head of household filing status. For instance, the standard deduction for 2018 is $18,000 for head of household, as opposed to a single filer's $12,000. The married filing separately status is good for high earning power couples, people who think their spouses are hiding income, people with spouses, especially new spouses, who have tax liability issues, or people going through divorce. This method may benefit you if you want to be responsible only for your own tax, or if this method results in less tax than a joint return. Restrictions include the taxpayer cannot deduct student loan interest, the taxpayer cannot take child and dependent care expenses credit, there is no earned income credit available to the taxpayer, and the taxpayer can only deduct $1,500 of capital losses instead of the normal $3,000. Perks to this status include if your student loan repayment plan is based on income, then your monthly bill may be reduced. However, it is important to note that in community property states like Texas, this perk would effectively be nullified. The married filing jointly status is the status most married couples choose. With this status, spouses file a joint return. In this joint return, the spouses report their combined income and deduct their combined allowable expenses. Spouses are responsible for each other's admissions in these returns, so it is imperative that they check each other's work. This includes their math. If one gets a divorce on the last day of the taxable year, then the IRS will treat that person as unmarried for the entire year. Divorcing and then remarrying in the new year to avoid taxes has been tried and it does not work. If a spouse dies during the year, then you may still file jointly for that taxable year, even if there are no children in the home. Perks for this status include that the taxpayer's tax bill generally will be lower than filing separately. If the couple does not itemize, then they could have a higher standard deduction. Additionally, they may be able to take advantage of deductions or credits that are not available when filing separately. The qualified widow or widower status is for people who have recently lost a spouse and are supporting a qualified child at home. The widow or widower must have paid more than half of the upkeep for the home during the taxable year. If the spouse died in 2018, then the widow or widower can file jointly for 2018 and then for the next 2 years as a surviving spouse. The perks of the widow status allow one to file similar to married filing jointly. The qualified widow or widower may find a higher standard deduction and better tax bracket than if filing as single. The single filing tax status is for unmarried taxpayers, taxpayers who are on their own. As aforementioned, if you are legally divorced by the last day of the year, then the IRS considers you unmarried for the whole year, thus allowing the taxpayer to file as single. If your marriage was annulled in the taxable year, the IRS considers you unmarried even if you filed jointly in previous years. Perks of the single filing status revolve around the phenomenon of the marriage penalty. Simply put, married persons end up in higher tax brackets faster than single individuals.
Now, this is the end, and we would like to thank you for your time, and we hope that you've learned something and gained some insight into how to use each of the tax filing statuses of the Internal Revenue Code. Thank you.